Yo guys, hope you are doing good. Welcome to the new video. In this video, I will explain about the liquidity cycle and the phases of the liquidity cycle. So, liquidity cycle is nothing but the liquidity grabs in the market. So, normally the smart money structure will go like this. How the newbie smart money trader will assume the direction of the market is through the structure. If the market is break at the nearest high, he will think it as a bullish intention scheme. Then he will trade from the order block. So he will assume the direction of the market through this. But in the reality, the markets don't move like this. The markets somewhat move like this. Liquidity grabs, liquidity grabs. So if you have the quite bit experience from the markets, you can know this is a false view of the structure. This is the real structure of the market. This is how the market moves. So when coming into the real context, this is how the smart money people will get stopped out in the market. After the break of the structure, they will think it as a break of the structure and they will place the buy orders here. But what happens is the market will just sweep the buy orders and it will go into the real direction. Again, after sweeping, what the smart money people will do, again they will sell from here. What the market maker will do, they will again take the liquidity, move in the real direction. Same thing happen over and over and over and again after taking the liquidity. So the liquidity is the main thing than the structure because market moves from liquidity. If you use your psychology, the markets need money to move the price. Where's the money? The money is in every high and low in the markets because after this liquidity is taken, if you see this aggressive price push because the liquidity is taken, again the liquidity is taken, aggressive price push, again today liquidity is taken, the price is going down, and this pattern happens over and over and over and again in the markets. This is a repeatable pattern in the markets. So in this video I will explain how to trade the liquidity phases from phase 1 to phase 2. The liquidity expands. As the structure expands, the liquidity in the market also expands. If you see here, after taking this liquidity, we got a nice push again. After taking this liquidity, we got a nice push again. After taking this liquidity, we got a very good push in the markets again. After taking the liquidity, we got a nice push. So if you see how the market is moving, we know how to catch the entries. So there are 4 phases usually we use. This is the liquidity phase 1, liquidity phase 2, liquidity phase 3, liquidity phase 4. This is how we understand the higher time frame of the market, which liquidity is taken and where the market is heading and what liquidity is going to be taken. So with the uses of the strategy, we can exactly know where the market is going. Again, if you see here, Thursday the market exactly swept this. Liquidity is taken. What? When the liquidity is taken, then the real direction of the market establishes. See, real direction came. These patterns happen over and over and again. Same thing happens here too. The previous internal liquidity is taken, and this is the Asian liquidity. There are 2 liquidities aligning each other. When the 2 liquidities are aligning each other, it's a very high probable trade. Liquidity got taken out. Here the smart money people got wiped out and the retail people got wiped out. Then the real move happened. Usually when the stop hunts occur, there will be a speed and aggression candles will be there. When the stop hunt occurs, there will be a speed and aggression candles like 3-bar pattern. If you see, there are 3 executive black candles out there. huge speed and aggression into the stop hunt. If you see the 3 candles after that, how can you see how much push it was, how many push it was? Again, same scenario here. Push to the liquidity ticked phase 1. If you see how much push it gave. Again, same thing happens over and over and over again. If you go to the 16-minute time frame, you can know how this 3-bar pattern is working. If you see, this is the breaker block. Can you see the speed and aggression to the downside, taking the sell side liquidity, and the market gave huge reaction. Again, if you see, there are 3 bullish candles. So if you see the stop hunts, if you understand the stop hunts in the higher time frame, you can definitely trade the market from one liquidity point to the another liquidity point. But it takes so much of practice. You can't trade by just knowing the technical stuff of the market. It's a lot of mindset. If you want to acquire this edge, how I trade from the liquidity point to the liquidity point, you can just message me on the WhatsApp. I can add you in my private group so you can learn the liquidity strategy well. I have done a lot of research and backtest with the strategy. Same thing. Previous internal liquidity is taken exactly at the tip. Today news is there. The news candle took the liquidity. Exactly the news candle. News candle took the liquidity and we can trade here. 0.5, so 4.5 stop loss. You can trade 4.3 are not a bad deal. This is how we trade the markets from the liquidity point perspective to the liquidity point perspective. Hope you enjoyed the video, guys. To join my mentorship for the liquidity breakdown of the liquidity cycles and stuff, I leave my WhatsApp number in the description. Just text me there.